Our first speaker this afternoon is Jennifer Dunn. Jennifer is a partner in the Charlottetown office of BDO Canada LLP. Jennifer has over 20 years of experience providing proactive tax planning and compliance services to a wide range of private companies and their shareholders. She specializes in tax minimalization strategies, corporate reorganizations, and business succession planning. Jennifer is often called upon as a tax expert and has provided testimony before the Senate of Canada. She has also appeared on CBC's Compass and Maritime Noon, as well as in publications such as The Guardian and Atlantic Business Magazine. Jennifer joins us to discuss capital gains tax and considerations for succession planning.
Thanks a lot, Ben, and good afternoon, everyone. I spend a lot of time with farmers, and there's one thing I know to be certain. No one works harder, takes on more risk, or plans further ahead. You're not just running businesses, you are stewarding the land for future generations. Recent changes in tax policy could cost farm families millions of dollars in the next decade. So today, I want to provide to you some key insights and solutions that hopefully will keep more of your hard-earned money in your pocket. We always have this disclaimer, so everything I say today is general advice. And I encourage you to talk to a professional advisor if you have additional questions. We'll jump right in with the lifetime capital gains exemption. When I think about the different tools I have in my tool belt to use when I'm doing tax planning for clients, the lifetime capital gains exemption is probably the most powerful. Essentially what it does is it will eliminate regular income tax on the sale of qualifying assets up to a gain of $1.25 million. And so qualifying assets, what does that mean? So to qualify, it could be farmland, it could be buildings, quota. If you have a company, it could be the shares of your company, or if you're in a partnership interest. There's a lot of words on this slide, so I'll break it down very simply. If you're selling shares of a company or a partnership interest, there's two other tests that we look at. One's called the 50% test, and the other's the 90%. The 50% test basically states that for any 24-month period, more than 50% of the fair market value of the assets in that company or that partnership have to be primarily or principally used in the farm. And then the 90% test, when you actually go to sell the shares of a farm company or your partnership interest, 90% of the fair market value of the assets have to be used principally or primarily in the farm. And so I've worked with some farm companies that have been very successful, and they've built up excess cash. Now, while that's a nice problem to have, what happens is that excess cash, they will invest in maybe GICs, buy investments, maybe buy other real estate not related to the farm. And that can put the farm offside meeting these rules that would enable you to get capital gains exemption, which can be pretty devastating. I've written an article on this called Farm Transition, Is Your Farm Offside? And you can find that article on BDO's website. Just go to bdo.ca. Google my name, Jennifer Dunn, and it should come up. And so why does this matter, the lifetime capital gains exemption? I thought showing you an example would be powerful. And you'll see with the lifetime capital gains exemption, if someone is reporting a gain of $1.25 million and they have their full exemption remaining, they will pay no tax, which is wonderful. But if they don't have the capital gains exemption, if what they're selling doesn't qualify, and on a gain of $1.25 million in PEI, you'd have a tax bill of $323,000 approximately. So very powerful, this exemption. So April 16th, 2024, it was sort of a sad day. Does anyone want to guess what day that was? April 16th. It was budget day. It was the federal budget day. And we learned that the capital gains inclusion rate was going to go up from 50% to 67%. I've always said that for tax policy to be effective, you need two things. You need it to be fair, or perceived to be fair, and two, you need it to be predictable. And so when you talk about fairness, I know that's a very subjective term, but we have what's called a self-reporting tax system. You file your tax return, you report your income. And if a taxpayer feels that it isn't fair, well, maybe you're motivated to be a little more aggressive in what you claim as deductions. Or maybe someone's gonna commit tax evasion, or maybe they're gonna leave Canada and move to a more tax-friendly country. When it comes to being predictable, for a taxpayer to be able to plan out their affairs, there has to be some certainty into the tax rules. I've been practicing, well, Ben said more than 20 years, it's actually been more than 25. And in the last 9 years, I have never seen our tax system more tumultuous, and it has created a lot of uncertainty, and especially around this capital gains inclusion rate. So when we look at the old rules on the capital gain inclusion rate, for an individual, when you would sell something, a piece of land, as an example, and you sold it for a gain, only 50% of that gain was taxable. And you would pay tax at your marginal tax rate. And hopefully, if you had some of your capital gains exemption remaining, you could claim that and maybe pay no tax. And that exemption rate, it was just over $1 million, and it has gone up, though, to 1.25, which is nice. For a corporation, again, if that company sold a piece of land at a gain, only 50% of that gain is taxable. The other 50% that's not taxable, I'm able to pay out to a shareholder tax-free through what's called the capital dividend account. The corporate tax rate's quite high, it's 54.67%, but a good portion of that is refundable once taxable dividends are paid out to the shareholder. So what are the proposed changes now for the capital gains inclusion rate? Well, there's been a lot of commentary on this lately. Originally, this rate was supposed to go up effective June 25th, 2024. We found out April 16th. So as a tax advisor, I reached out to a lot of my clients who I knew maybe had accrued gains in their companies and said, you may want to consider selling some of these assets that had gains to benefit from a lower inclusion rate. Well, there's been a lot of pushback on this. And then in January, government was prorogued. And so this never became law. Even though it never became law, CRA was saying it was going to assess based on that it was law. And that wasn't fair. And so it was not, well, it was just January 31st that Finance Minister Dominic LeBlanc came out and said, okay, recognizing there's creating too much uncertainty, we will push back the effective date to be January 1st, 2026. So again, this still isn't law, and fingers crossed maybe that it doesn't become law. But if it does, this is what's going to happen. Capital gains up to $250,000. Still, the inclusion rate is 50% for an individual. Anything above that, the inclusion rate will become 67%. And then you'll be taxed in your marginal tax bracket. For a corporation, the inclusion rate for all gains is at the 67%. And then also the non-taxable portion isn't as much as it would have been. And so you don't get the larger benefit of that, what's called the capital dividend account. here's an example of an individual. Let's say they sold some land and they had a gain of $2 million. Under the old rules, you'll see the capital gains exemption was just over $1 million. Taxes on that would be around $250,000. So an effective tax rate of 12.72%. The new rules, because the capital gains exemption is going up to 1.25 million, taxes a little bit less, and the effective tax rate drops. So that's good. But what if you don't have the capital gains exemption? Again, if you had a gain of 2 million, your tax rate is going to be around 25.88%. But under the new rules, it's going up to 33%. So additional tax in this scenario of, it's almost, just over $150,000. If it's a corporation, if a corporation has a gain of 2 million, under the old rules, tax rate would be around 30%. Under the new, jumps to 40. So in this example, you're paying over 200 grand more in tax. Succession planning. When I think of succession planning, there's some overarching themes that I've put into 6 buckets. We have family dynamics, and sometimes this is the most difficult, I must admit. And when I think about family dynamics, it's about alignment of expectations, ensuring all family members understand and agree on a transition plan. There's the fair versus equal argument. Not all children may want to farm, so decisions must balance fairness with business viability. And then conflict resolution, establishing clear processes to address potential disputes. And then ownership and management transitions. So who's going to take over? Identifying the successors and their readiness to manage the farm. A phased transition, does that make more sense? Consider gradually handing over responsibilities and ownership. And then the role of non-farming family members, developing a plan for those who will not be involved in the operations of the farm. So maybe their inheritance would come from other assets like life insurance. There's also financial and tax considerations. What's the farm worth? Determining the fair market value of the farm and its assets. Capital gains and tax planning. Utilizing tax strategies such as a lifetime capital gains exemption, maybe an estate freeze or a corporate restructuring to minimize tax. Funding retirement, we can't forget about this. Ensuring that the retiring generation has financial security without burdening the farm's cash flow. Legal and estate planning, wills, clearly defining how your assets will be distributed. Shareholder agreements, very important for a farm corporation. If incorporated, it'll establish agreements outlining ownership changes and buyout terms. Business viability and growth, debt management, very important, ensuring that the farm can sustain existing debts and new financial obligations. Diversification and expansion, considering future growth opportunities and how they fit into succession plans. Government programs and grants, explore any available support to help you do this type of work. And then timeline and implementation. We always say to people, start early. Succession planning often does take a number of years. Utilize professional advisors, so accountants, lawyers, financial planners that specialize in agriculture, and then review the plan regularly. So the estate freeze, and I call this the old standard. Historically, it was oftentimes an estate freeze that we used to bring in the next generation onto a farm. And what exactly is an estate freeze? It's a tax strategy that transfers future growth of the farm to the next generation. And I think it's shown best in a diagram. In this scenario, we've got the Family Farm Corporation owned by mom and dad, and they've got common shares. And let's pretend this farm is worth $2 million. They would freeze the value of the farm by exchanging their common shares for fixed value preferred shares. That allows their children to subscribe for common shares, which are the growth shares, for a nominal amount. So the pros of using an estate freeze, it's pretty simple to do. Probably the biggest con of doing an estate freeze is that mom and dad are going to have fixed value preferred shares. How they usually get dealt with is that the farm will buy those back over time. And when the farm does that, that's considered a dividend to mom and dad, not a capital gain. A dividend is taxed at a higher rate than a capital gain, so not as beneficial. Another scenario that we look at is what I call Bill C-208. And I've done a lot of these transactions, and I really like this. I don't know if a lot of you have heard of Bill C-208. It was a private member's bill put forward by Larry Maguire, who is a conservative MP in Brandon, Manitoba. And he felt it wasn't fair from a tax perspective that it was more beneficial for a family farm to sell to a stranger than to their own children. And so he put forth this bill, and everyone's surprised it passed. But you can guess who didn't like this. It was the Department of Finance. They didn't like the way the legislation was written, and they were afraid of people that weren't going to undertake what I'd call a true intergenerational transfer. And instead, they thought these would be fake sales just to allow mom and dad to be able to extract tax-free money out of their company. And so the Department of Finance said, even though this received royal assent on June 29th, 2021, they were like, nope, we're gonna, pause it, and we're not going to allow it to go through. We want to look at it a little further, so it won't come into effect until January 1st, 2022. Well, there was a lot of uproar in the tax community and also the agriculture community, and the Department of Finance had to be reminded that when a bill receives royal assent, it's law. And so, effective June 29th, we were able to do this type of planning. And as a tax advisor, I jumped on it. Any of my farm clients that were ready to possibly transition, I made them aware of this and said, these are the benefits of doing so. So I'll walk you through what this means and what this transaction looks like. So typically, when someone goes to buy a farm corporation, let's say it's me, I would incorporate a company. My company would go to the bank and borrow, and again, let's use $2 million. I would borrow $2 million in my company to buy the shares of the farm corporation. Why I want to use a company to borrow the money is because a company's corporate tax rate is only 10%. In some cases, it jumps to 31%. But it's easier to pay down debt with after-tax corporate dollars than personal. And so that works really well if I, a stranger, was buying a farm company. But if I was the child of farmers and I went to do that, you're offside. And this section of the Act, this 84.1, would deem the parent to not have a capital gain when they receive proceeds from their child, but it would be a dividend. And the tax difference is on, I'm going to flip forward to the next slide. So with Bill C-208, a parent could have a capital gain of 1.25, selling their shares to a company owned by their child. There'd be no tax. But without Bill C-208, if they attempted to do that, they'd have a tax bill of almost $600,000. And so the legislation has changed a little bit over time. The Department of Finance did tweak it some. And one of the things that they talked about is when you do a Bill C-208 transaction, it can either be what's called an immediate sale or gradual. An immediate, although the word is immediate, it means that management has to transfer to the child within 36 months. Whereas gradual, it speaks to it being over 60 months. In both cases, you are giving up, the parent is giving up voting control to the child. With a gradual, though, you can still have what's called de facto control. You could still have the majority of the value of the farm. But again, you are giving up voting control. So that is something that has to be considered, that you'd be comfortable with before you undertake this kind of transaction. The advantage of the immediate transfer over gradual. So when it happens, let's say again, the parents are selling the farm, the company for $2 million. The child is going to issue a promissory note for $2 million. That note can remain outstanding, like there's no repayment terms. So as cash flow from the farm allows that note to be paid down, there's no rush. Under a gradual transfer, within 10 years, 50% of that promissory note would have to be paid down, which, depending on the value of the farm, that may be difficult to do. So I'm more in favor of these immediate transfers. I guess one of the advantage of a gradual is, again, you have a longer time to transfer management. You can do that over 60 months versus 36. But what I tell my clients is this: although you're transferring management, which is defined as being able to direct the day-to-day activities of the farm, you can still give advice. There's nothing wrong with that after this transition period. I want to show you what this looks like in slides. So we have the family farm company, and it's owned by parents. The child or children incorporate a new company, we'll call it NewCo. Then NewCo is going to buy the common shares of the Family Farm Corp from the parents, and NewCo is going to issue a promissory note to the parents. Then we're going to amalgamate these two companies so that we're just left with one, and that company will still have this promissory note owing to the parents. Why I love this kind of planning, it's twofold. It enables the parents to possibly get capital gains exemption on the sale of their shares to their children and pay no tax, which is pretty sweet. Also, instead of the child having to go out and borrow from a bank, but they can, assuming that the parents are willing to get paid out over time, cash flow from the farm can be used to pay down the parents' promissory note. And oftentimes the parents are generous to their children. The loan will be non-interest bearing. And so it just works really well in helping to transition. What am I doing for time? Ben, I'm at time, so I don't know, we started a little late. Maybe I'll go ahead to, okay. I don't want to forget about gifting either. And so perhaps you don't expect to get anything from your children and you just want to gift some farm property to them. Well, what kind of property can you gift? You can gift land, depreciable property like equipment, buildings, barns, quota, your shares in a company or a partnership interest. Inventory, if you're a proprietorship, you cannot gift on a tax-deferred basis, so just keep that in mind. And so the gifting, it's ideal when a parent isn't expecting to get anything from the child. What are the conditions of being able to do a gift? Well, your child has to be a resident of Canada. Again, the property being gifted has to be used principally in the farm, meaning more than 50%. And at the time that you're transferring the shares or a partnership interest, all or substantially all of the property has to be used principally in farming. And so when we look at these tests of this 50% test in time and property usage, I'll give you the example of a parcel of land. And let's say you've owned that land for 30 years and you've farmed it for 20, but you've rented it for 10. Well, because you farmed it for 67% of the time you owned it, which is more than 50%, that parcel land is okay. That's all right. Also, CRA will look at, again, let's look at a parcel of land and the usage of it. And so more than 50% of that land has to be cultivated, so arable land that you're using in farming. So if you have a parcel of land that has a lot of swamp, woods, and it exceeds 50% of that parcel, that particular parcel would be offside and wouldn't meet that definition. So again, if you're dealing with a company or a partnership, at the time of the transfer to a child, 91%, more than 90, have to be farm assets versus redundant excess cash. And then in the case of, say, you're transferring land, more acres have to be cultivated, and also more years have to be actively farmed for that property to qualify. And when you do a gifting, you can either choose to transfer it at your cost, which is called like a rollover, no tax is generated, or you can do it at fair market value or anywhere in between. If you do it more than cost, then actual consideration must be paid in the form of cash or a promissory note. And that's what we tend to see, is the children would issue a promissory note to their parents. And oftentimes then the parents forgive that note. And if they forgive it in their will, we avoid what's called debt forgiveness. And so these kinds of transfers to children, the gifting, it can occur during a farmer's lifetime or at death. So in conclusion, like when you're doing succession planning, the three critical questions are: who is taking over, identifying your successors, how will it be funded, what are the tax implications. That next slide, just a little bit more about me. And I can appreciate, I know that talking tax isn't the most exciting thing, especially compared to a day in the field, but I can promise you this: if you take action now on succession planning, you're going to save your family a lot of stress, and also, hopefully, you'll save yourself an unnecessary tax bill. My team and I, we work every day with farm families on essentially tax minimization so that we can maximize your wealth. So thank you for your time today, and I wish you all the best in the upcoming planting season. Thank you.
Is there any questions for Jennifer? Give them Daryl?
Hello? Oh, hi, I'm live. Jennifer, quick question. If you're sitting on cash as a farmer and you want to go through one of these transactions, if you choose to invest that cash in the farming operation, does it automatically qualify then as, it's now a capital gains asset immediately, or would CRA look at that and say, you got to take some time before that investment actually qualifies?
No, if you're taking that excess cash and immediately investing it in a farm asset, you're good.
Thank you.
You're good.
Anyone else?
Thank you, Jennifer.